Hello everyone, welcome to this overview of statement of cash flows. So statement of cash flows basically involves tracking how cash flows through the company. So we don't care about any of the other things. We're just going to see what the cash transactions are involved in each one of these operations. So first of all, there are three sections. There's cash flows from operations, there's cash flows from investing, and finally there's cash flows from financing. Cash flows from financing, I would say, is the least important of them all. Focus mainly on the first two because they usually don't ask cash flows from financing, just because the first two make it long enough a question already. So with that, let's get started with statement of cash flows and cash flows from operations. So the very first item that we add in cash flows from operations is net income. We get that from the income statement. We add that figure here. Next, we're going to go through the income statement and pick out all the non-cash items. And whatever we've done in the income statement, we'll be reversing those changes. So these are all items that have been subtracted from net income. So the net income here, these have all been subtracted from it, but actually don't represent cash transactions. So going down to the income statement, first of all, we have amortization here, which is depreciation. So you will note that when we incur a depreciation expense, we don't really pay anyone that amount, right? That's just an internal accounting that we are doing, and we are not paying that amount out to anyone. So we've subtracted that amount. So this amount we'll be adding back in. Next, we have loss on sale of equipment and gain on sale of long-term investments. Both loss on sale and gain on sale are values relative to our books. It's not the cash that's involved in this transaction. You'll understand what that means later when we cover cash flows from investing, what that really means. But for now, just know that whatever we've done in the income statement for loss on sales and gain on sales, we'll reverse that. So we subtracted loss on sales, so we'll add that back in. And we had added gain of sale, so we'll subtract that out. Now let's go back up. Next, we have the balance sheet current items. So here we are going through the current assets section of the balance sheet and current liability section. And we follow different rules for different ones. So for current liabilities, if we see that from 1 year to the next, the amount of current assets have decreased, then we will add that amount in. If we see that the assets have increased, then we'll decrease that out. You can think of this in terms of, say, buying something. So if you buy, say, prepaid insurance, your cash decreases, right? Which means as your asset has increased, it corresponds to a decrease in cash. So which is why we are doing opposite. So when an asset increases, our cash decreases, which is why it follows the opposite rule for current assets. Next, you have current liabilities. For current liabilities, it goes in the same direction. So if you think of it, you can think of it as a bank loan. So when the amount of bank loan on your balance sheet increases, it means your bank loans increase, which means that more cash has come into the company because you borrowed that money. So an increase in a current liability corresponds to an add. And if the current liability from 1 year to the next decreases, we'll subtract that amount out. Okay, next we'll do cash flows from investing. This involves tracing all the cash transactions that take place from the sale or purchase of all of the long-term assets. So cash flows from investing only deals with long-term assets. Cash flows from operation was all income statement and current assets and current liabilities. Now, cash flows from investing is all the long-term assets. So for each of the long-term assets that will be listed in the balance sheet, we're going to create a T-table and see what's happening. You'll know the starting balance and ending balance for each of them. And we'll trace the changes that are happening and find whatever missing values are there for increases from cash of sale. So anytime we sell assets, we gain cash for that, which is why we add that amount in. At the same time, when we purchase assets, long-term assets, our cash goes down, right? So that's what's happening here. Next, and lastly, we'll be doing cash flows from financing. For this, at each turn, you'll be checking whether the amount of cash that comes into the company increases or not. So again, if a liability increases, if your bank loan increases, that means your cash has increased, right? Which means an increase in long-term liabilities, an increase in the cash. Similarly, a decrease, which is the first 2 points here. Now, cash flows from financing has long-term liabilities and equity section. These two sections are covered within cash flows from financing. Next, you have dividends paid. Now, they might give you the figure for dividends paid in the question itself. They might tell you $100,000 or $200,000 worth of dividends are paid out, in which case you just subtract that amount out because we paid out dividends or cash decrease. But even if they don't tell you that, you can still find out using the formula given here. And then when we issue common stock, we get money, right? So when a common stock increases, we gain that much money. But at the same time, when we repurchase common stock, we find how much cash that was involved in that transaction, and we subtract that out. Now, this last part, they almost certainly will not ask you, but mostly cash flows from financing, it's been very rare. I can't remember a single instance when they've asked this one. It's always been the first two. So I would pay less attention to that one. It's good to know, but focus on the other two if you're struggling with this topic. So let's go on to this statement. So the very first thing you do when you write any statement is you put down the titles at the top. So first is the name of the company, Roland and Sons. Next is the name of the statement, so that's statement of cash flows. Next, you have your date. So this is for the year ending December. Not sure what I did there. December 31st, 2008. Okay, now let's get started with cash flows from operations. So the very first thing we do in cash flows from operations is write down the net income. And the net income figure is given here, 140,500. Next, we check all the non-cash items for in the income statement. So non-cash income statement item. So the very first one was depreciation. We had subtracted depreciation, so let's add that back in. Add depreciation expense. And that amount is 60,000. Next, we had a loss on sale. Let's add that back in. Add loss on sale of equipment, 20,000. Lastly, we have a less. So we had added this gain on sale. Let's remove that non-cash item. So less gain on sale of long-term equipment, which is minus 15,000. Great. Now let's go to the balance sheet items. So you can just call it current asset in balance sheet or some form of title you can give it that explains that you know what you're doing. So cash, ignore this one because we'll account for it at the very end. Let's do accounts receivable. So accounts receivable here is increasing, right? Let's see how much it's increasing by. It's increasing by 9,000. So it's an increase of 9,000, which means we have to do the opposite for assets. So we'll be decreasing that amount. So let's do less increase in accounts receivable. Now this is where it's important to write less or add increase and whatever the account is. This is why it's important to include both, because you can see that for assets, we follow the opposite rule. So it increased, which means we are deducting this amount out. So it increased by 9,000. So let's subtract it by 9,000. Now, next we have merchandising inventory, which increased by 16,000. So if it's an increase of 16,000, we are going to decrease it from our cash flows, less increase in inventory. And 16,000. Lastly, we have prepaid expenses. Prepaid expenses are also increasing by 8,500. So again, let's subtract. And the amount is 8,500. Now, if there are any assets that are decreased, we would be adding that back in. But in this particular question, that's not the case. Next, let's go to our current liabilities. The first one being the first the first current liability being accounts payable. So our accounts payable is decreasing. Therefore, for current liabilities, we do the same thing that's happening in the balance sheet. So we'll decrease our cash by that amount. So our cash is decreasing by 5,000. And that's a decrease in accounts payable. Next, we have wages and salaries payable, which is increasing. How much is it increasing by? 7,000. So we're going to add that amount back in. Add increase in wage payable of 7,000. Next, we have interest payable, which is again an increase of 4,000. So we'll add that in. Increase in interest payable of 4,000. And lastly, we have income tax payable, which is also going up. So it's also an add. Increase in income tax payable. That is 2,500. Okay, now that we have all of this, just add up all these numbers. You add to the net income, this figure, subtract this, subtract, add. So let's go ahead and do that. It should give you a cash flow from operations of plus 180,500. This is what you should all be getting. And after this, let's jump to the cash flows from investing section. Now let's start with cash flows from investing. The very first step we'll take is we're just working with these three items now. For each one of these, let's create T-tables. So first of all, we have long-term investments. Then we have capital assets. Let's see. Lastly, we have accumulated depreciation. So let's put on all the starting balances. So for long-term investments, it started off at 177 and went down to 127. Capital assets started off with 1035 and went up to 1250, 123. And lastly, let's do depreciation. So here we have credit balances. We have 262, 123 and 2121. Perfect. Now let's see what all additions and subtractions happen here. So from the long-term investments, we'll subtract out any long-term investments that are sold, and we'll add any long-term investments which have been purchased, right? Similarly, for capital assets, we'll add in any purchased capital assets, and we'll remove any current asset, any long-term assets sold. Lastly, for depreciation. So depreciation will increase by the depreciation expense for the year. And the only amount going out of this is the debiting that we do when we sell an asset. So this will be the accumulated depreciation of assets sold. Okay, now let's go to the question and try to fill out as many of these blanks as we can based on the information that we are given. So I'll deal with long-term investments a little later. Let's first work with capital assets and the accumulated depreciation associated with it. So we are told that during the year, we sold equipment that cost $210,000. So let's put that figure here. We sold $210,000. That's the original cost. That's what we removed from here. Then next, we are told that the depreciation expense. Let's find the depreciation expense. The question told us here that it was 60,000. Now you have to find what the accumulated depreciation for the assets sold is. Now you can see that that's the only missing value here. So it's fairly easy to find. At the same time, there's only one missing value here, which is the original cost of the assets purchased. So we can find that value there. Lastly, when we sold this asset, that's the original cost of the asset. That's not how much cost, not how much cash we got in that transaction. So we have to find out that when we sold that asset, what is the cash transaction that was involved in this? For purchases, it's easy, right? Like if you remember your journal entries for a purchase of asset, your debit is the equipment, so whatever asset it is, and your credit will be cash. So in this case, it's the same. The amount that the purchase price is how much cash you paid out for it, right? But when it comes to capital assets, and when you sell these assets, remember you have 3 journal entries at that point, 4 in all. So you have your debits, you're receiving cash for selling of the item. Next, you have to debit out any accumulated depreciation that's associated with it, which is this right here. Next, you have to debit out any loss on sale. And you have to credit out the equipment itself, so the original cost of the equipment. And in case there's a gain on sale, then you have to also credit the gain on sale. But if I recall in this particular question, if we go up here, we only have a loss on sale of equipment. So we know that it's a debit here. So let's put in that loss of sale value. That's 20,000. So loss on sale is a debit of 20,000. Now let's see what the missing accumulated depreciation in this is. So accumulated depreciation, it's a simple enough equation to solve. So that's 262 plus 60 minus x, assuming this is x, is equal to 212. So we can just take this on the other side. That gives us x is equal to 262 plus 60 minus 212. Which gives us an x is equal to 110,000. So now we know that the accumulated depreciation amount was 110,000. Next, let's find, so accumulated depreciation, let's put that value in here. Now we need to know what the original cost of the equipment sold was. So the question here tells us that the original cost was 210,000. Now that you know all of these, the only one missing right here is this. So let's go ahead and find that. It's pretty easy. You add up your debits, you add up your credits, you see which one's more, and there'll be a missing debit value, which we'll find here. So our debits add up to 110,000 plus 20,000, which is 130,000, which gives us a difference of 80,000. So this 80,000 is the cash that's involved. This is the cash that we got, cash from sale of PPE. Also, the cash from purchase of PPE, which is this missing value here. So all we have to do is find this missing value. So that's 1035 plus X minus 210,000 gives you 1,250,000. So let's rearrange this. You get 1,250 plus 210 minus 1035 equals X. Let's find that value. This gives us 425,000 equals X. So this 425,000 is how much money we got when we sold the PPE. So purchase PPE. So now we know how much cash we got from purchase of PPE. We know how much cash we got from sale of PPE. We can put those amounts down in our cash flows from investing. So let's go ahead and do that. Let me move this here. Cash flows from investing. First of all, let's add in cash from sale of capital asset. How much is that? We figured out here. It was 80,000. And we are adding this amount because we got cash when we sold it. Next, we'll subtract out how much ever cash for purchase of whatever the PPE is. In this case, we determined it was 425,000. So that's a minus 425,000. Then lastly, let's see what's happening with long-term investments. So long-term investments is going from 177 to this. Has the question told us anything? Yes, the question told us that we sold $50,000 worth of long-term investments for 65,000. So this question makes it easy because it's already told us what the cash involved in that was. We sold $65,000. We got $65,000 for the purchase, sorry, for the sale. So let's add that amount in. So add 65,000. Not gain on sale. This is cash from sale of long-term investments. Perfect. Now let's see and check whether there's any long-term investments that was sold. So let's add that purchase value in here, which is what we are told. We are told the original cost was 50,000. So $50,000 worth of long-term investments were sold. Let's do the math on this. So if we do this equation, we see that the purchase here is 0. So that means there was no purchase. We didn't purchase any long-term investments. So the only thing that happened was a sale of long-term investments. Now let's add these figures in. So cash flow from investing is minus 425 plus 80,000 plus 65,000. Gives us 280,000. So it's a minus 280,000. So after this, let's go to cash flows from financing and see what's happening. Before that, let me just give you a quick rundown on cash flows from investing, because this is the part that people mostly struggle with. First of all, you're making T tables for all of your assets. So there'll be some PPE that's involved, and there'll be some depreciation that's associated with it, accumulated depreciation. We'll find all the values. We'll determine how much PPE was purchased and the cash amount for the purchase will be how much ever we purchased it for. So that's easy. Next, we're going to determine how many assets were sold. But this amount sold that we'll determine will be the original cost. So we have to see how much cash flows involved in this process. So it basically, the cash flows from investing will mostly have three entries. It will have an add cash from sale. It will have a less cash from purchase. The purchase one's fairly easy. You just take this amount and you put that here for purchase. For sale, you have to use the original cost, see how much depreciation was involved, write your journal entries down. So you have your cash, accumulated depreciation, your loss on sale, and you have your equipment. And now you'll see how much cash is involved because you know the other three. You just have to see what the cash in the transaction was involved. And this cash amount you'll put down here in cash from sale. So again, it's fairly straightforward. You're just doing this for all the assets and you're checking whether something was sold or not. It could happen in the question that they don't mention specifically that assets were sold and purchased. But once you do the T tables, you'll realize that actually the numbers aren't adding up, which means there was a sale that they haven't mentioned in the question. But I would expect them to normally mention that. So it's fairly straightforward. At this point, I'll be starting cash flows from financing. Again, feel free to skip this section if you are overwhelmed and you think it's too much, and focus on the other two, because those will almost certainly be asked, and this one probably will not be asked. But it's still fairly easy to do, and I'll walk you through what the process looks like. So now we go to our cash flows from financing. Now, when we're doing cash flows from financing, we worry about the long-term liabilities, which in this case is just one, and our equity section. So the very first item is let's deal with the long-term liabilities. So long-term liabilities have increased, which means our bonds payable has increased, which causes an increase in cash, right? So if we've issued a bond, that means we received cash for it. So add increase in bonds payable of 225,000. Next, we see our common shares is the same. So in this question, it happens to be the same. But if it wasn't, then we'd add any increase in common shares because when we issue shares, our cash increases. So increase in common shares, and we'll less out any decrease in common shares. It just happens to be 0 for this question. Lastly, retained earnings itself does not represent any cash that comes in or out. However, we will have paid dividends. So the last item that we'll deal with here is dividends. So we've paid out certain amount of dividends according to the question. It does not tell us how much dividends we paid out though. So let's go ahead and figure out how much dividends were paid out. So for this, there's a simple enough equation. You take the retained earnings at the start of the year. To that, you add the net income. You subtract dividends paid, which gives you your retained earnings at the end of the year. Now it's fairly easy to find these three figures. The only one missing is how much dividends were paid. So let's see, retained earnings went from 462 500 to 503.23. Now net income, how much net income are we adding in? We'll be adding in the net income here, which is 140,14055. So 500. And there's the dividend paid, which we have to find. So this is a simple enough equation again. And we solve this. So 462,500 plus 140,500 minus x is equal to 503,123. Okay. So let's move these around. You get x is equal to 462,500 plus 140,500 minus 503,000. Now after this, you get an x value of 100,000, which means the amount of dividends that were paid out were $100,000. So when we pay out dividends, our cash decreases. So less dividends paid, we can just call it dividends paid. And that is minus 100,000. Right? So this gives us the cash flows from financing of 125,000. Now we have all three sections. Let's see what we do at the very end. Let me move this in here, rest of it. Okay, now we have all three of our cash flows. We have our cash flows from operations, we have our cash flows from investing, and we have our cash flows from financing. Let's add those numbers up together. So that is the change in cash. Adding up those numbers, we get 25,500. Now let's write the starting cash balance. So starting cash balance was 90,500. Add these up, it should give you your ending cash, which if you do the math comes to 116,123. Now you will note that this amount that you see here will actually end up being the same as the ending cash value here, 116,500. I mean, I made a mistake of 500 somewhere because we're starting wrong, but both those values are correct. And once you get this should be, yeah, 116,123. And here we have the same amount. So as you can see, this is how it basically works. And it's a fairly straightforward thing if you understand how to do it. And follow this general table that you have right here. Take a screenshot of it if you'd like. And this is the general pattern that all of these questions follow. And it's fairly easy to do. But if at all you're struggling with this question, skip to some other one and then come back to this as the very last question. That would be my recommendation. But either which way, cash flows from operations very easy, so you should be able to do that. So with that, the video comes to an end. Thank you.